Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Today on the podcast, we have Kathy Fettke returning. This was recorded for the 2026 Virtual InvestSmart Summit a little bit ago. This was one of 7 amazing sessions we had covering the economy, building an investment thesis, tax strategies, longevity, and other alternative investment strategies. You can buy the recordings and hear from the 9 expert speakers at investsmartsummit.com. Let's hear from Kathy as she shares her insights on the 2026 economic outlook, including risks, resets, and real opportunities. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com. Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Let's just start with, of course, we want to know the state of U.S. housing, but let's talk about why. Why is that important? And obviously, we want to have the dream of having enough rental income to cover our expenses. So keeping that in mind, I think what people are worried about is the reality of things today versus the dream. Can we still make this happen? Can we still acquire properties that will bring in enough cash flow and bring in enough wealth to be able to have it cover our expenses someday? This is a chart to show that, at least in the single family world, U.S. home prices, it looks like in this chart that they're coming down, but they're not negative. This zero line means that the price growth has really slowed. So if you're buying 1 to 4 units, it's not going to be for appreciation, at least not in the last few years. But then when we look at 21, there was so much price growth, obviously, in single and multifamily, that what's happening now with the slowdown is really more of a catch up of where it should have been had this bubble not happened. So the fact that it hasn't gone negative is kind of amazing, considering you look back at 2008, and a lot of people like to compare today with 2008. We didn't have as much of a bubble even then. And then obviously had a huge decline in home values during that time. So this last one, people think, well, if we had an even bigger bubble, does that mean that the down is going to be even worse? So let's look at that. The fact of the matter is 256 of 387 metro areas are below their peak. And again, data like this can be kind of scary. Are we in a housing crash? We know that price growth has slowed, but are we going to start seeing negative? And in some areas, that is the case. Punta Gorda, that Sarasota, Cape Coral part of Florida was one of the areas that bubbled the most. I mean, people were moving there. Austin, too. You see that on the list. Lots of people moving to these areas, builders coming in. And as a result, with cheap debt, people were able to buy more than they could. So if we go back to the prior slide, you can see that in some of these areas, if this is the average, Punta Gorda and Sarasota, they were up here. They, in some cases, were having 30% appreciation in 1 year. So when you see that values have come down 22% in those areas from that peak, it's not as bad as it sounds, because it kind of brings us back to where we might have been had things been normalized and not 2% interest rates, right, that drove prices up. But it is still scary. If you bought a property in these areas in 2021 at the peak, you're feeling the pain. But for people who bought before that in 2019, it's not as bad as it sounds. And then you've got these other areas like Ocala that held a little bit more. It's only down 4% from that crazy wild peak. So we're really kind of living in what I'm calling two separate worlds, which is the high appreciation, a bit more volatile markets that I know very well. I'm born and raised in California. We've watched people make a tremendous amount of money. But if you buy at the wrong time in California or any of the quote unquote bubble markets, if you buy at the peak, it'll come back. It has historically, but it takes a while. After 2008, when the housing market crashed, it took about 10 years for values to come back if you bought at the peak in San Francisco. So it doesn't happen overnight, but boy, if you bought at the trough, you made millions. You made a lot of money if you buy the right time in these kind of bubble markets. And when I say that we're starting to see two separate worlds, there have been some surprising markets that have been added to what I'm used to in California. Usually the high price markets experience these dramatic ups and downs. But now we kind of see Texas on there. We see Florida, Idaho. So these are areas where perhaps a lot of California money went, or, money from high priced areas and helped to drive prices up. So these states are kind of experiencing something they haven't so much in the past. And then you can see the slow and steady states. That's why so many people love the Midwest. They love these linear markets because they're just less volatile. And right now, they're the winners. These kind of, it's showing up, the darker the blue, the kind of greater the appreciation. This has typically happened where when the high-priced markets get overbought, overbuilt, they bubble out. This always happens. It used to happen every 10 years. Then the Midwest and the linear markets tend to boom because people kind of can't afford those coastal markets. They can't afford to live in those expensive places, or they sell at the peak because they cash out and they realize they could go live somewhere else for much cheaper. And it's just kind of a back and forth cycle that seems to happen a lot. So in general, specifically in these bubble markets, we're in this reset. And this is what you often see. There's like an, opportunity presents itself. I would say that was like 2009 to 2012, amazing opportunity. People started to jump in and see the opportunity. Then it expanded for, like I said, about 10 years. Then people get like crazy, like, oh my gosh, my friend just doubled their money. I'm going to do it now. And then everybody jumps in because everybody's met somebody who's made money. And then it bursts. It's like too easy of money, too easy of deals. Then something changes. It could be COVID, could be interest rates going up. And then boom, the bubble resets. And that is the opportunity to make money. Just again, like 2009, a lot of people couldn't see it. The opportunity often comes from disaster or comes out of that disaster. If you had bought in 2000, anytime, even if you bought in 2009, you'd be riding the wave down. It wasn't really till 2012 that it started to go back up again. But even if you bought as things were going down, you made a lot of money. So let's talk about what a lot of people are concerned about is because price growth is slowing pretty rapidly. Does this mean that we do have a crash ahead of us in the 1 to 4 unit world? And what's so different today versus before is that homeowners are sitting on a tremendous amount of equity, just record amounts of equity. And that's because so many people are locked into these low rates and they don't really want to refi to get that cash out to get into a higher interest rate. It just doesn't make sense unless you really, really need it. So a lot of people really aren't, and they're just letting their loans sit there and they are rich. And you can see that, debt has gone down while the equity has gone up. So it couldn't be more different than 2009 where the debt was high and the equity was low. I mean, we're talking about just a completely reverse situation here. Debt low, equity high. And again, I am only talking about the 1 to 4 units. We're going to get to multifamily and commercial in a minute, but they're kind of dependent on each other. So I like to start with single families. What I know well, it's what, we do at Real Wealth is focus on building those 1 to 4 unit portfolios. But also, we've got our syndication side. So they go together. If the housing market crashes, it's going to affect apartments. If apartments crash, it's going to affect single families. So a very important thing to notice, and very different from 2009, is that 40% of homeowners own their mortgage free and clear. So very difficult to face some kind of distress when you own your house free and clear. And then those who do own, they're on low fixed rate debt. At under 3% is 20% of those who own loans, and 3 to 4% is another 30%. So you're starting to see more and more people in the 6% and up. You can see that's more, 21% or more, but still an enormous amount of people locked into those low rates and low payments. So you've got these extremely strong borrowers. This blue line is people with credit scores over 760. That's been the bulk of those who have gotten loans. They have extremely strong credit. Whereas back in 2008, this dark blue area, that was people who had a history of not paying their bills, the subprime, which really kind of took the market down. If you don't have a history of paying your bills, why it's not, you already have bad credit, why not just walk away? But that's not the case with over the past decade. It's been ever since qualified mortgages came into place in 2012. I know it seems kind of obvious you should have qualified mortgages, but we've only seen really very strong borrowers. That's why today delinquencies are low. This blue line is mortgages. It's very low historically, even lower than in the 2000s, the delinquency rate. And that's because people are sitting on so much equity. If they run into some kind of, situation, they lose their job or they get sick or whatever, they can sell their home and get a tremendous amount of equity, cash out and move on. And it doesn't have to go to delinquency or foreclosure. What we are seeing is student loan debt skyrocketing. We're seeing car loan delinquencies going up, credit card for sure. So there is credit distress out there, but it's not really with homeowners, which means it might be with renters. It's the renters feeling the pain. Negative equity, very, very low, very, very low. Look at back in 2009. It's like you could get, you didn't have to qualify. You didn't have to have good credit, but you could get a loan at no money down, or even over that, get money back. So there was no equity. And then when prices fell, boy, you were really underwater. So you can see the difference between then and now. There's no comparison. Like I said, you run into distress, you sell your home and you cash out your equity. Back then, you just gave it to the bank. There was no equity to preserve. So the issue today really is the state of U.S. renters. When you want to gauge the housing market, you've got to find the distress. And it is not with today's homeowners, not in that 1 to 4 unit. They are actually on the party bus. They are doing great. They have very low payment to income. Their wages have gone up, but their payments have stayed the same and they're low. So the real distress today is with U.S. renters. They are, first of all, facing a world where they'd like to be homeowners, but more than 75%, this is from Money Watch just last week, more than 75% of homes across the U.S. are unaffordable. Americans now expect to be 40 years old when they buy their first home. The majority of prospective buyers are waiting for rates to fall further. Good luck with that. And many think that they could just kind of do it on their own with AI, or AI can help. So we'll talk about that in a bit too. The buy versus rent, it's in some cases just makes more sense to rent. If you buy, you might be paying double what you pay to rent. So why? It might be the better financial decision to rent than buy in some areas. I mean, certainly in California, that's been something I've been teaching people for years is, hey, why not just rent? Your dream house in California, it's always been this way, probably half the cost to rent it than to own it. And just buy rental property elsewhere. So people are smart. They've got AI. They've got a lot of technological support to determine these types of things when it just doesn't make sense maybe to own in certain markets. So as a result, we've seen rental household surge. It's come down a bit because of immigration policy that is, with this current administration. But in general, if you can't afford to buy, what are your choices? You're going to be renting, or you're going to be living with friends or with mom and dad. Now the White House just came out with this last week. I don't know if it's accurate. I have heard who knows? There are so many estimates of the amount of homes that are needed, but the White House came out and said that their economists estimate the U.S. has a shortage of 10 million homes. And according to that's according to the new report. And they say regulatory cuts could lead to more construction to stabilize prices and increase home ownership. Now, I like the sentiment. Nobody loves the amount of red tape we have to face and the cost. My goodness, the cost to get anything off the ground. We have syndicated subdivisions all over the country. We've got them in Florida, Oregon, and Boise, Idaho, and Reno. And it doesn't matter where you are. We went to Reno thinking it would be easier. It's still difficult. There's so much red tape and it's so expensive. California, obviously, being very, very difficult. Will reducing those fees help? Yeah, of course it'll help. But inflation is inflation and everything's more expensive. So how much will it help? Labor is more expensive. Materials are more expensive. Property taxes, insurance. So it's a good thought, but can you really build affordable housing? Even if the process becomes easier, it's just expensive. We have lots in Utah. We were required to build 30% affordable, which means that the person who makes the average income, so it might be they look at a firefighter or a teacher, could they, afford a home? And we had to build 30% for them. That meant that we had to build about 20 units that were about $375,000 so that they could be affordable. And it cost us over almost $1 million to build those homes. So, it's a loss leader, right? You have to do it. So you better hope that you make profit on the other homes that you're building. But very, very, very difficult to bring in affordable housing. And whoever cracks that code is going to be very wealthy. All of this is happening at a time when values are down. Inventory levels are down. So you've got low inventory, and yet this big wave coming, this group right here, the largest demographic that we've ever seen in the US, ages, 32 to 36, forming families, having babies, wanting pets, wanting a yard, at least a place to live that they can afford. This group is coming into a world that is very expensive, very difficult. So the distress really is for this group trying to find an affordable place to raise their family and not able. Add to it that household size is decreasing. People are having fewer kids, and there's a dramatic increase in single person households. So where are they going to live? It kind of opens up that opportunity to rent by the room or, again, apartments. Interestingly enough, the Trump administration has been really attacking Wall Street, owning homes, but not just Wall Street. People like me, I have a single family rental fund. I've got another one that, we've got our second one now that we're raising money for. And then you've got the government saying, nope, you can't do it. I think it was under 100 or over 100 homes. Oh boy. Most of these big funds have thousands. But what's so interesting when you actually look at the numbers, the number of rental homes compared to the number of homes out there has gone down dramatically because, like I said, landlords who saw prices go up so much in 2022 were like, hey, I'm going to make more money just selling this. I think I'll just sell it and retire. So a lot of the single family rental homes that were on the market are not there anymore. So going after Wall Street's maybe not going to help the situation. It could really make it worse because not everyone wants to live in an apartment. When you want dogs and children, maybe you want to rent that home. And, it's become like illegal. You can't do it if you have too many of them. So it is very interesting. Maybe we're attacking the wrong place. And once again, here's another John Burns slide showing that the percentage of rental properties actually going down. So what does this mean? It means we have an opportunity to provide affordable housing. And if anyone knows how to do it, it's us. It's you guys. It's learning how to find older homes, older apartments, or building new ones affordably. This is the distress today. It's not the housing market crashing. That is not happening. You can't crash a market where people own free and clear or are in very low payments. Prices going up is not a reflection of a bubble. The people who are buying have to prove that they can afford to buy it. There's just so little on the market that there's enough people who can afford those higher prices. You don't need that many. It's under 4 million. It's right around 4 million homes being sold every year. In 2022, it was 6 million homes being sold. So we're down by a third of homes, being sold every year. So those who can, do you think 4 million people out of, 300 and however many million Americans there are can afford? Clearly, yes. But what about the rest? What about the rest? How are they going to live? Well, really what we're seeing is that people are choosing affordability, like where can they live, where it makes sense. And the dark blue, again, is the areas where most people are moving. Texas, you see, Florida, even though prices have really softened there, this is still where people are moving because it's more affordable. There's less taxes. There's more opportunity. But you can see there's a lot of light blue areas as well where people are moving. And partly, you can see here on U-Haul Growth Index, number one for 2025 was still Dallas, then Houston, then Austin, then Charlotte, then Phoenix, then Nashville. These are markets that Real Wealth has been in. I know these are markets where Break of Day has been in. They're looking for areas where people are going. And that's the metro. Then you look at the growth cities, Ocala, Myrtle Beach. You look at the list, McKinney. We've been very active there. St. Augustine, love that. Again, where people are moving. People are moving where they can make more money and live a life. Where people have seen their wages go up is, again, Texas, Idaho. Look at Kansas City. We really like Oklahoma now. Florida's still on there. And then you could see kind of some areas where wages have not gone up as much. And I find this to be interesting, this study that was done by Visual Capitalist. Where are businesses moving? Businesses like affordable places too. They want to be able to have their headquarters and pay people a good salary where they can live a happy life, not make the company broke. So businesses move to affordable places too. And you can see that the San Francisco Bay Area has lost the most headquarters. The most businesses have moved. Great. Then Los Angeles, then New York City, then Chicago, then San Diego. Where did they go? Number of new headquarters, 2018 to 2024, Dallas, Austin, Nashville, Phoenix, Houston. Businesses want affordable places too. So as buy and hold investors, we can help solve this problem. If you're a flipper, you can too. If you can buy something cheap, fix it up, and put it back on the market at an affordable price still, whether it's single family or multifamily, this is what is going to save the day. This is what's going to solve the distress that's out there. And as investors, we're rewarded for doing that. We get appreciation. We get forced appreciation. We get cash flow. We get to pay down our debt or have someone else do it for us. And then the government incentivizes us to do this by giving us pretty unbelievable tax benefits. Tax benefits, I just don't know that exist anywhere else except maybe oil and gas, but then oil and gas maybe doesn't have these other things. So the ROI for solving this problem is pretty tremendous. I'm just going to pass through that. One thing I think people don't, where they get stuck is they look at year one cash flow, and that is just that's not where you're going to make your money. I'm just showing a duplex here. But let's say you bought a duplex and you put 146,000 down. You got closing costs. Your rent is going to be most likely the lowest it will be that first year. So your return might look terrible that first year, but it's really the years ahead. It's buy and hold for a reason, because over time your rents go up. Over time, you're able to see that appreciation and get, enjoy it. So let's talk about multifamily. Where are we in this cycle? And yes, same thing. It is in the reset phase. So many people went a little crazy in that euphoria point, which I'll talk about in a minute. So 2012 to 2021, we saw cheap debt, we saw cap rate compression, you saw asset inflation. Everyone looked smart. Not everyone, but a lot of people. You could, buy for cheap, sell it at a lower cap rate, get a bunch of money and go do it again. So really the tides were in our favor. And then there was the shock, and that's what created the reset, 2022 to 2025, interest rate shock, major shock. That is very rare to see interest rates go from 3% to 6% almost overnight. And people didn't put that in their pro formas. They were not expecting that. Additionally, generally during that euphoric time, builders are euphoric too. And when they underwrite stuff, they're like, oh man, stuff's moving so quickly, it's selling, we better build some new supply. And we're going to underwrite it to these low rates. And boy, oh boy, were they in for a shock when all prices went up. Just the cost to build anything just dramatically went up, made it very difficult. And so many pro formas were based on rents going up. Well, guess what? Didn't quite happen. Rents either stayed where they were or went down in a lot of places. So you had income coming down, expenses going up, and loans coming due. So clearly a recipe for disaster in multifamily for those who underwrote with just one pro forma in mind, one result in mind, that rents would go up, that costs would go down, and that values would increase, and that you'd be able to refi at the same rate or better than you had. So, wow, if you want to look at distress today, it truly is in multifamily. There's a $2 trillion maturity wall, loans resetting, owners needing equity, lenders demanding their capital. If you want to compare today to 2009, it is not in the 1 to 4 unit housing world. It is in the multifamily and commercial world, specifically multifamily. This is where the opportunity lies today. Here's just another example of the maturity wall by property type. Multifamily by far feeling the most pain. Office a little, but it's a tough time right now. Overall distress rates by property type, again, office feeling some distress, multifamily right there in second, then hotel and retail, industrial, manufactured housing, and self-storage. Hopefully you're in those asset classes. Those are doing all right. Multifamily delinquency. Now here's what's finally happening. Up until now, banks have been doing the extend and pretend game. They didn't want to foreclose. A lot of multifamily operators were either doing capital calls or just hoping rates would come down. That has not happened. So the multifamily loan delinquencies are rising dramatically. Look at that. And losses are following. Multifamily loan delinquency increased 3.4% in just 2 years, or 3.4 times, and now at a 12-year high. An overwhelming majority is 90 plus days delinquent, roughly 7 billion. So what's happening? Well, special servicers are getting more aggressive. They're not playing the extend and pretend anymore, and foreclosure is now the dominant strategy. REO plus foreclosure, deed in lieu is 53%, 15 billion foreclosed in December of 2025. So this is, again, the 2009 of today. It is in multifamily, and there is tremendous opportunity out there. Foreclosure volume up 68%, modifications taking a back seat. That's kind of how we got here, because maybe banks were thinking rates were going to come down too, and like, hey, maybe we can save this deal. They don't like foreclosing. They don't want to be the owners of multifamily like we do. They're just in the lending business. They just don't want to have to foreclose. They want to work it out, but they can't wait forever. So where are you going to find, the best deals? Again, if you want to invest where people are moving to, even if you find a great deal, but you can't rent it out, it's not going to be that great of a deal. So you want to avoid places where people are moving from and invest where people are moving to. So the fastest and slowest growing states from 2024 to 25, you can see there, South Carolina, Idaho, North Carolina, Texas, Utah, Delaware, Washington, Arizona, Tennessee. You come over before that, those were the areas that were growing fastest. And the areas that are growing slower, Vermont, Hawaii, West Virginia, New Mexico, California, so forth. So I'll just skip through that. I have, I talk about this California rental I've got. This was a house that Rich and I owned. It's our first house in Malibu. And we made the mistake of trying to rent it out. We rented it out to a friend and she lost her job. And that property has been sitting basically with her in it and no payments for over a year now. We have tried everything. She's over 62, so she's got all these ways of delaying the process. So I've been teaching people for years to only invest in landlord-friendly places. And I made the mistake and here we are. But the opportunity is pretty fantastic. I can 1031 exchange this either into a multifamily or something else, but I just want to walk you through kind of what we have in mind with the value maybe being around 1.3. It's at a 4.25% interest rate. Does it make sense to keep it or sell it? And my thought is, my goodness, no, I'm not doing any more long-term rentals in California now that I've experienced what it's like, that the laws are not in your favor. No one cares that I have a $6,000 a month mortgage on that. They don't care. What they care about is that the tenant, wow, she's the victim here. So it's been negative cash flow, $6,200 a month for a year, but it has equity. So I can't short-term rental it because it's California. I have to live there. So I can 1031, I can 1031 into some kind of deal. But what's exciting is that you can 1031 into you can't really 1031. You can 1031 into some multifamily syndications. But one kind of fun thing is I could basically buy a bunch of properties with a $500,000 loan. I've got to make sure that I 1031 the debt too. So I have to have about $500,000 worth of debt, but I'll have leftover. I could buy, what do I gonna say? I don't have it on there. Okay, that's why I was confused. Yeah, I 1031 into 5 properties, 325,000 down at 25%, but I'd have leftover money, 225,000 left over to buy some properties all cash. And then after some time, I can refi those, take that cash out tax-free and invest in someone's syndication. I just wanted to share that is a strategy that I'm looking at today to try to get out of California property in case anybody else is feeling that pain. Now, I don't know if you listen to the Real Wealth Show, that's my podcast, but I had Robert Kiyosaki on there in 2004, 2005, and he really helped guide me through the years. And I should have listened to him more because I went off path and I did some things that were not this, which is what I learned from Kiyosaki. Invest in areas with job growth, population growth, infrastructure growth, but are still affordable, because that's how you're going to get the cash flow. That's why Rich and I have invested in these areas that do that. Okay, so that's a little bit about me. I ended in time so I can stop sharing and answer any questions you might have.
All right. Thanks so much, Kathy. Yes, everyone, if you have questions, take advantage of this time, put it in the Q&A. And I fully agree. Multifamily, obviously a lot of pain and a huge opportunity right now.
Yeah, I'm just curious what you would do with my situation. So I've got this $1.3 million house, $550,000 loan on it. I have to 1031. I've got that $500,000. I have to, 1031, and I have to carry that debt forward. Can put about 200 and something down. What would you do?
Well, it's funny. We get a lot of people that come to us with 1031 options, and for a lot, like our threshold is 750 because there's a lot of paperwork on our side to bring an investor in. Um, and I always tell people, because I've seen this mistake happen where they're so focused on a 1031, they get into a bad deal. Now, I know you wouldn't do that, but others that don't have as much access as you are just so fixated, like on that, like I've got to do it, and you've got, what, 90 days to identify and 6 months to get into something. So it's just there's a lot of pressure, and they get into something they shouldn't. Um, Actually, on our current deal, someone the timing didn't work, and so they're just doing the lazy 1031. They're just taking their proceeds from the sale and investing with us, because they'll get the bonus depreciation, which will wipe out
Which
their
offsets it kind of. Yeah.
exactly.
I was going to ask you about
Um,
that because we maybe the capital gains isn't so bad. Maybe it's
yeah,
not so bad that it would, if I count all the renovations we've had to do to this property, my husband was a little bit concerned about the recapture because we've rented it for about 5 years, but I think it's still something to really consider is just paying the capital gains and investing in multifamily, knowing that multifamily, like this is the 2009. If you could, everyone says, could I turn back the clock to 2009 and just do that? It's like, it's here. This is it. Like you couldn't see it back then. Were you investing in 2009? Because it was scary and people didn't know how to make decisions because you didn't know there was going to be another decade of run up.
right.
But
I was on a very, very small scale, so I was looking to sell a house and get into something else, and um we were in a short sale for like forever, like a year, and like it was insanity, and ultimately um it was a great decision. We moved down to Manhattan Beach. My girls were we lived in LA and in the Unified School District, and looking for a community where we weren't going to pay for private school and get good public schools. And it was the best investment because we've been down here, and the homes that I've had here have appreciated tremendously. So it was on a small scale, but still, going through that cycle. And then I had a business during that time too, working through that cycle.
yeah,
But yeah,
well, I can
I
just tell
think
you that it was like you didn't know. It was scary that when people try to compare today to then, what is similar is the fear. Is that you don't know what's coming next. All you know is you're in a major crisis. You don't know if the US is going to come out of it. The politicians didn't know if we were going to come out of it. There was
right.
a Senate hearing where they're like, we might be insolvent. And that's when they just turned on the printers, right? They just were like, we've got a solution. We're just going to print a ton of money. And that's kind of become the solution. That is the solution now. So here we are again in a time of fear and like, what's next? And what do you do? And I had a mentor at the time who was in his 70s and he wasn't even worried. And I just thought, how do you not be worried? I was stocking food and I told my husband to get a gun. I'm like, I don't know what's going to happen. And that's really how people feel today. But I remember watching him like, why is he moving ahead? Why are we moving forward on deals when we don't know if there's going to be a US of A? And but we were buying stupid good deals. We bought a riverfront townhome built. It was like 27 townhomes that were 70% complete, and the builder went under. So we were able to pick it up for $3 million when it was worth about 20 million. So, but still I was afraid. But what if we can't sell them? What if we can't rent them? What if we can't finish them? And he just was like, it's a deal. Like we're going to be okay. And certainly was. Investors made over 30% IRR. But I remember watching him like, how is he staying so calm? And that's kind of how I feel. Now I'm the old person. Now I'm the one who's been through cycles. And I'm like, yes, I don't like what's happening in the world. But I also see that there's deals. And it's going to come back and it's going to be okay. And if you get it for that good of a price, like it's going to be okay. So I don't know. That's what feels similar is there's fear, but there's also like tremendous opportunity.
Right. And whenever there's fear, that's when
That's when there's the opportunity, right? Yeah, it goes together. You got to be brave. But you also have to know how to underwrite. That's the key. Like people didn't understand underwriting in 2022 and we're just making silly assumptions. And, and I know you weren't one of them because we would look at your deals and they did make sense. But it's like, that exuberant phase, people let their underwriting, they go soft on their underwriting.
Yeah.
And so today people are learning, no, we need to have a best case scenario, a worst case scenario, not just one predicted outcome. This needs to work if this, and this happens, right? This deal needs to work if rents go down. This needs to work if, rents go up, if costs go up. So I think people are smarter today and just, are going to look at that. And that's why when we make offers on multifamily, it's kind of ridiculous what we're our offer. And sometimes, and they're not taking it. They don't understand. It's not like we're just trying to lowball. It's just what it should be,
right?
For all of the numbers to make sense, this is the price. And a lot of the sellers kind of aren't there yet. Would you agree?
Yeah, absolutely. And it's funny because, on the last, not on this deal, they were very realistic, but on a few previous deals, like we had our number and it was a few million below what the buyer, what the seller wanted. And I said, I told the broker, this is where we're at and this is our reasoning. And if it makes sense, let me know. And we went through the whole process and it ultimately came back down to where we were because we did a fair analysis of where it should be priced. Now, certainly there's been sellers that, said, forget it and didn't sell or whatnot, but you have your number and you build in safeguards because not everything goes perfectly. And you have to, like any business, there's going to be ups and downs and you have to plan for that. And if the seller is willing to meet your number, then great, you have something that you can work with. If not, plenty of other deals. I hope you guys got as much value as I did. Kathy provided a ton of great data points for you to make more informed investing decisions. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.